Just a second. All right, I think we're on board here. Hold on, let's make sure we're on Rumble. Hold on just a second, Don. Let's make sure. Y'all see us out there, guys? We got me and the handsome and dapper Don Graves with us, as you can see. Let me know if you guys give me a couple thumbs up if you can see me. I see a bunch of people in the comments, but I don't see it hasn't reflected yet. Okay, there we go. All right, sweet. All right, let's see. Hold on just a second. There's usually Don about a 15-second delay in the comments. Okay, cool. We're online. All right, guys, this is fantastic. So we got Don Graves on board here today. Last minute, I emailed him. I can't remember. You emailed me. I can't remember. Man, Don and I have talked on occasion by email. I think we did talk one time before. We did talk a couple times, and about reverse mortgages. And I'm amazed, my friends, how many people just are ignore the opportunity that exists in using their equity to finance their retirement. It boggles my mind how many people have this a prejudice against reverse mortgages. I think needs to be overlooked, and I don't know why. I think Dave Ramsey has something to do with it, frankly, and that bothers me. But my man Thomas, as a matter of fact, sent me a video, and Thomas P., who I like, he comments, I disagree with him on reverse mortgages. It's okay to disagree. We can still be friends.
Mm-hmm.
He sent me a link on another Dave Ramsey video from last year and if my man Don Whitaker's on here, I saw you post a comment on Dave Ramsey's video, Don, and that comment kicked butt. And you also had worked with Don Graves here as well. So Don, you're a good person to kind of maybe disavow some of Dave Ramsey's misleading stuff on reverse mortgages. This is me saying this. This isn't Don Graves. It's just your old buddy Josh saying it. So I'm not trying to put Don Graves into my negative things on what Dave Ramsey says about this stuff. But anyway, so Don, welcome to the show, man. I very much appreciate you having here, sir.
Oh, beautiful. Thank you, sir. I appreciate you.
Well, Don is coming to us right outside of Philadelphia, so we won't hold them that accountable to him. It's not his fault that he hasn't moved south yet, right? I mean, you got to get out of Philly. You got to get out of that southeastern PA area, Don.
I started south and came north.
Oh, really? All right. Where were you?
Daddy's from Falmouth, Kentucky. Mama's from Winchester.
Winchester, Virginia?
Winchester, Kentucky.
Oh, I don't even know where that is.
We've got Kentucky folks.
No. So how'd you end up in PA? Job, I guess? Job related?
College.
Oh, okay. Where'd you go?
Started out at the University of Cincinnati, then transferred to Temple University.
Temple Owls, yes, sir.
And that's where I stayed. So
right.
I've been here since 1985.
You've been in this whole time in the Jenkintown area since 1985?
Just outside,
Yeah, right on, man. All right, sweet. And your better half is from Falmouth, Kentucky. Did she follow you to Cincinnati and then to Temple?
I met her in Pennsylvania.
Oh, okay, gotcha. So you started in financial services how long ago, Don?
I started in my background is fairly eclectic. I had a ministry, ecclesiastical background in college and went to seminary and did that for several years. And then I became CEO of a nonprofit called Habitat for Humanity here in Philadelphia and did that for several years. And one day my sister called me. My sister's 14 years older than me. And she said, "Little brother, I think you should consider a career change." And she told me about this program that was supposedly helping seniors. And I tell you, Josh, it scared the wits out of me. I said, "Oh no, you're going to jail on this one. You're taking old people's houses. Don't talk to me anymore. Don't talk to me anymore about this." And so I didn't talk about reverse mortgages for a whole year after that. I didn't want to hear about it. I didn't want to know about it. It was the devil to me. And so out of that 23 years ago, it took me a year to even come back to it. It took me another 6 months to research. And I talked to 5 counseling agencies in Greater Philadelphia. I had breakfast with 3 of them. I talked with HUD, talked to Fannie Mae, talked with AARP. And I wanted to know, what's the aha? What's the fine print? What's the gotcha? And after I did all that research, here's what I came away with. This is a viable and useful tool for the right people.
Yes.
And I jumped in 23 years ago, in the year 2000, is when I started that journey.
Oh, man. That's funny, man. And that's a lot has changed. What is an ecclesiastes? So I know, the book that Solomon wrote, Ecclesiastes. What does an ecclesiastes ministry mean?
Ecclesiastical just means clergy.
Oh, okay.
And I went to seminary. I became a pastor, and I lived in Africa for a season and worked on college campuses here and served as a traditional pastor.
Okay, gotcha.
So sometimes I don't say clergy. I just use the term ecclesiastical.
Okay. And your sister, out of the blue, called you one day and said you need a career change. You're like, hey, I think I'm doing okay at the CEO of Habitat for Humanity in the Philadelphia.
She did. I was used to talking to my sister Michelle, and because my intent, she's like I said, she's 14 years older than me. My intent was to come finish up my undergraduate in finance, go back and work with her in her business. And then I met a wife and fell in love and all of that. But we were used to talking. She was always doing innovative things, cutting edge things. So when she talked about the reverse mortgage, that wasn't unusual. But the way she described it and the way I heard it, that was a tad bit frightening. So I didn't do anything with it because I thought, no, I don't want anything to do with that.
So how did you end up doing like the Heckum Advisors Group? I mean, because Don, you're obviously a well-known guy in this realm of the industry. I mean, you started as, you didn't know anything about it. You started looking at, talking to people, looking for the aha moment. But you built a pretty substantial career on this area. How did, just knocking on doors? I mean, how did you get so well known as the one of the experts of the business, man? I mean, it's just time in business.
Yeah, really it is. When I started, all that research I told you I did, Fannie Mae, HUD, and all of this, I knew this was going to be a valuable tool if it were in the hands of right people. That anything can be abused. Any product, program, resource can be abused.
Right.
So for me, I wanted to work with financial advisors.
Yeah.
I wanted to work with people who had clients who could use it, but they also would be serving as a guide, an advocate, an expert, a fiduciary in some ways. So I built my business on the Josh Scanlons of the world. Say, how do I educate a broad group of financial advisors to understand how this product and tool could be helpful for their clients, creating an even more sustainable income? Well, what happened was there was not really a library of third-party articles. Everything was sales related. And so very early in my career, I chose not to wear the tie or emblem of any company I was representing, but just to begin to compile educational resources, third-party sources, and doing a lot of it, and present education. And so if advisors said, Don, this is good. Do you have an article on gray divorce? Or do you have an article on annuities and reverse mortgages or long-term care sequence risk? And that's where we started what was the Heckum Advisors Group. And that's and its sole purpose was to provide a resource, not a sales resource, but an education platform for advisors.
For advisors to answer their questions about, hey, how does this work here? How does it work? Right on. Okay, gotcha. Yeah, and it's got a lot of data in that place that not just advisors, but anyone can visit too. That can say, "Hey, I'm curious about this. I don't want a sales pitch necessarily, but I'd like to see what what some of the information is that might not get on the anywhere else." So, reverse mortgages obviously have a bad connotation. Like my man here says, the word "reverse landman" is like an undo your mortgage and live on the street. And I know we don't call them reverse mortgages anymore. I get it, but still, we do. So the bad connotation for reverse mortgages is why specifically?
Yeah, sure. Let me rewind the tape. In 23 years, I've heard that. And what is a reverse mortgage? For the listeners, for those who are watching, it's 4 letters: IJAM. IJAM. Now, what is that? It's just a mortgage. It's just a mortgage. It started in Europe, end of the 1800s. First came to the United States in 1961. It became part of the federal government in 1988. It's one of 3, listen, folks, it's one of 3 federally sponsored or supports for retirement. Social Security, 1935, Medicare, 1965, and the Home Equity Conversion Mortgage, HECM, The nickname is Reverse Mortgage 1988. So it's 43 years old here, this reverse mortgage. And so what is it? It's just a mortgage. It's just a home equity loan. It's just a line of credit. It's not new. It's not dangerous. It's not spooky. And but what happens is when you say, no, it's just a mortgage. Oh, no, it's not, Don. It's this. And Josh, here's what happens. Here's the story I get. Don, I was over my cousin Tracy's house, and Uncle Junebug came out of her spare bedroom, and everybody said, Uncle Junebug, why are you coming out of Tracy's spare bedroom? And here he said two things. He said, I got that reverse mortgage, and I lost my house. And everybody at the barbecue turned and said, I knew it. And by Saturday afternoon, people got on the phone. Sunday, they were at the early meeting with the deacons at the Baptist church, and they were telling the pastor mentioned, and Monday, it was at the beauty salon, Tuesday at the barbershop. And by the end of the week, the whole town knew someone who had a cousin, who had an uncle, who got a reverse mortgage and lost his house, right? And that's what we hear. And people come to me and say, Don, how do you explain that? I said, let me tell you something. Uncle Junebug told the truth.
Right.
Aha! You are taking old people's houses. I said, no. He didn't tell the whole truth, but he did get a reverse mortgage, and he did lose his house. What he left out are the 4 requirements when you get a reverse mortgage. You got to live in the property, take care of it, keep insurance in force, and pay your property-related taxes.
Right.
Well, what Uncle Junebug didn't say, and most articles on the program, what they don't say, is people hadn't paid their taxes in 3-4 years, and that's not a reverse mortgage problem. That's the township, right? And so you get horror stories, you get tales, you get outdated information, you get mythology. And sometimes you get some true stories because there were bad actors in the space, and they did some things, and they were put out and dealt harshly with that. So I tell folks, the newly restructured reverse mortgage may be a little different than what you know. So what is a reverse mortgage? It's just a mortgage. It's a way for retirees age 62 or older, and there's some that can do it at age 55, to convert a portion of their home's value and turn it into tax-free dollars. Isn't that what you do at a home equity line of credit? You go to the lender, you present credentials, they say you got a $400,000 house, here's a $150,000 or $200,000 line of credit, right? Yep. Same thing with the reverse mortgage. So it gives you access to dollars that you can use. Here's the difference. You don't have to make a monthly mortgage payment, a mandatory principal and interest payment, when you withdraw the funds. So it's not impactful on your cash flow. The line of credit grows, and hopefully we'll talk about that. Someone will ask.
Yes, absolutely.
And so it's a home equity line of credit that's based off of the age of the youngest borrower. 3 criteria, Josh. You know this. Age of the youngest borrower, value of the property, and the long-term interest rate. Those 3 things produce a certain amount of money. It must be a first mortgage. So from those dollars, we have to pay off whatever you owe. Yeah. And then whatever's left over is called a GLOC, a GLOC, not a police-issued firearm, but a growing line of credit. And that's the basics of a reverse mortgage. Now, did Ms. Jones take all the money out, go down to the casino, put it all on red, lost the money, and then, I don't know, that wouldn't be a wise thing to do. The loan gets repaid when the last surviving borrower permanently departs the house, typically like any mortgage. At that time, whatever the person borrowed, plus whatever interest has accrued, gets repaid, usually from the sale of the property, but not always, it doesn't have to be. But it gets repaid, and watch this, and 100% of all the remaining equity passes on to the heirs or the estate, or if the client was alive and moved, it passes on to them. See, that's a reverse mortgage. It's leveraging the home to meet your retirement goals, and there are 52 strategies. And then whatever's remaining when it's over will be left to your heirs or your estate. And if it's done well and wise, it will be a much bigger pot of money left at the end.
When you factor in the entirety of the financial perspective, you know what I'm saying? 100%. Absolutely. See, that's the thing that drives me crazy too. It's like, these things feed off each other. A, your equity on your home. B, your investments. C, your income. It's all one big Josh and Charlotte, that's my wife, and not to only focus on one and not the other. I find that to be. We'll get your questions, guys. I appreciate it, Phil. Phil, we got a couple questions already.
Sure.
We'll
And Josh, isn't that what people forget? Particularly sometimes the heirs and the children. And I told you my daddy's from Falmouth, Kentucky, mama's from Winchester. That's my people. They got married, had the family. And I'm a simple guy. Mama said, when we die, would you rather have the apple tree or the orchard? Well, I was smart enough to know the orchard is better than the apple tree. And that's what you just said earlier.
Right.
We combined what's left in, if there's IRAs or investments accounts and annuities or whatever there may be, plus the remaining equity in the home. If it were done in such a way that the orchard is bigger, even if the apple tree was slightly
exactly 100%, man. That's
much better.
Absolutely.
Sure.
Absolutely. I definitely want to talk about the line of credit, Don. I want to make sure we focus like a laser. I actually think that's for me, that is such a significant opportunity for sequence of return risk and all that. But how you want to drive this? You got some spread? You got some stuff you want to show first, or what do you want to do in terms of?
Listen, I'm yours. I've cleared out today. I've tied a bow tie here by hand. I got this one from my closet. And my wife says, "What's going on today?" Oh, David, it's Josh Scanlon, and I gotta really get my beard right. And then she said, "Oh, you're wearing your gold ties, which Josh is important."
That's how special we are.
Normally I wear blue, but oh man, I came with it today. Josh, we'll start. If you've got a few questions to start with, we can do that, and then
let's talk a couple of these questions first. This is my dog Pablo, by the way, Don.
Hi, Pablo.
Wherever I go, Pablo goes with it. Let's see. So we got my man Phil, but we also have, hold on a second. Right, here's Phil. We got two Phils. All right. What happens when one spouse dies if you miss a tax or insurance payment, if the property value declines drastically, or if you don't keep up the property to the lender's standards? All right. So you don't pay your payments on taxes or insurance, the value of the property drops, and you don't keep up the property. What happens? All the nightmare scenarios, says Phil Stalter.
Put that question up, Josh.
All right, there you go.
Thank you. So when you get a reverse mortgage, the amount of money you get is based off the age of the youngest spouse, the value of the home, the current interest rate. Ballpark figures today, take the age of the youngest spouse and subtract 32. Okay. Right? So if you've got a 72-year-old and you subtract 32, that gives you 42. That's about the percent you can get from your house, 42%. Just age minus 32. Okay. So you get a reverse mortgage. The requirements are at least one of you have to live there. So if one spouse dies, no harm, no foul, right? Or if she puts you out, Philip, that's okay. Right. Nothing happens with the reverse mortgage. Live in the property. Take care of it. You're talking about lender standards. I'm in 23 years, 16,000 conversations, 3,000 plus personal clients. And though in every loan you get, forward and reverse mortgage, the lender has the right to inspect the property. In my 23 years, there's no mechanism for doing that. So we've never seen it happen. The one time it has happened is a client there's a storm and the tree fell on the client's house, but it also fell on the neighbor's house from the client's yard. So the natural thing would be call the insurance company, get it taken care of. But the client would not call the insurance company. So the neighbor called his insurance company. The insurance company found out who the other insurer was and had to call them. And the insurer called the lender to say there's been an incident. Your client needs to resolve that. That's the one episode I've heard of in 23 years because there's no mechanism no one's coming out and taking pictures of your property, seeing if you're taking care of it. So live in the property, take care of it. So don't let a tree fall on your neighbor's house from your house and not fix it.
Just the idea, Don, that people actually use this as a negative they're not going to have some jackbooted thug knocking on your door coming. I mean, anyway, keep going, Don. It just frustrates me.
This is not the Sopranos, or we're not sending folks out and saying we see your windows cracked. It's so HUD and Fannie Mae, there's a country to run. But I understand it. Well, how do you know? I told you the one instance I've had out of 16,500 conversations. So live in the property, take care of it. Pay your taxes and keep insurance in force. The thing that derails more people is that they don't pay their taxes.
Exactly. Right.
And then somehow you want to blame the reverse mortgage for that. I was in West Texas. On the front cover, there's a newspaper and had a couple, and they look real sad, and they're holding their grandbaby, and it says West Texas couple loses their house because of reverse mortgage.
Right. Yeah.
Anytime I see that, I get sad. I don't ever want that to happen. So I'm reading. You know, Josh, it took me 24 paragraphs, some of them big, some of them small, to find out why did they lose their house. They hadn't paid their property taxes in 4 years, and the township in West Texas took action. See, paying your taxes has nothing to do. You try not paying your taxes and see what happens, right? But that's not a good story at the barbecue.
It's a great story because you're putting out these elderly people who are preyed on by Don Graves of the world. And you're like, wait a second. I live in Fulton County, Georgia, Don. I guarantee if I own my house free and clear, the sheriff of Fulton County is going to come and put me out if I don't pay my property taxes. It has nothing to do with reverse mortgage. You guarantee. Don't pay your property taxes. The sheriff's deputy will come and put you out.
Sure.
Crazy. Drives me up the wall. And the idea, too, that you're going to – I was in banking, Don, for many years. Did many, many mortgages, many home equity lines. We always retain the right to inspect the property. Did I ever one time go out and inspect a property? No. You know what I'm saying? Why? Because I'm too busy trying to get other equity lines in. Not one time they go out. Even, it's funny. They do these construction loans. Mm-hmm. Construction loans, you're supposed to inspect the property for every eighth of the completion of the construction loan. That happens on the building to make sure they're actually laying the concrete foundation, all that stuff. Mm-hmm. But once the house is in order, no mortgage company is going to the guy's house and say, hey, Don, we noticed that your mailbox needs some paint, and if you don't do it, we're gonna take your house. All right, here's my man Phil Chevrolet, who big fan of Phil. He's a good guy. How does reverse mortgage help a retired person who is debt free? Ooh, right up your alley, Don. So I'll leave that up there, right up your alley.
Thank you, and thank you, Phil. One time, so I'm going to do a YouTube. Josh, can I tell them where to find me on YouTube?
Fine, man. Absolutely.
You can find me everywhere at Ask Don Graves, youtube.com/Ask Don Graves. And I'm not as advanced as Josh is, but I'm getting there. I'm learning to do it every few weeks. But one of the questions that comes up, Phil, is there an ideal borrower? Who's an ideal borrower? And in the book, in my newest book, this one here, The Retiree's Guide to Housing Wealth, I give 52 strategies. So how does this benefit a retiree that has no mortgage on the property? I don't know a particular situation. So I'm going to give you the 5, and Phil, jump in, please. The 5 most common concerns that retirees face. Number 1 is longevity. How long will my savings last? Number 2, lifestyle. Can I enjoy retirement on my terms, or am I going to have to cut back to make them last? Number 3, liquidity. Will I have access to tax advantage money when I need it? When their hearing aid costs $6,000, when the copay costs $3,000, when insurance didn't cover the tree that fell on the neighbor's yard and I had to come up with $14,000 liquidity. Number 4, legacy. How I'll be financially remembered. Number 5 is long-term care, the biggest overlooked and underplanned for expense in retirement. And so normally, Phil, I'll ask the client on a scale of 1 to 10, how much does the thought of running out of savings in retirement trouble you? 1, I'm not very troubled at all. 10, I'm very troubled by that, right? Same with legacy, lifestyle, long-term care, and liquidity. So let's say you've got a $500,000 house. Josh, how do I share my screen?
I think I got to make you, do I got to make you the?
Let me see here.
I think you can do it without me doing anything, Don.
Okay, then
try it.
I'll try it. I had
because we're not on Zoom. Is there a little share present thing?
Yeah, there is. Okay. There is. So while I answer Phil's question, so Phil, if you've got a $500,000 home, let's say you can access $224,000. I'm going to look for something because I want you all to see it. How could that help you? How would that be helpful to you? So, Josh, I'm going to try to share it here as best I can.
Try it. There's usually once you show your thing, I see it down here. I just click on it. So let me know when you're trying to present it. And I'll see another button that pops up for me to show it.
All right. All right. I'm going to try to present.
Yep. There you go. Right on. And I'll tell you if this button pops up or not on my end.
It says slides. I'm going to say your computer. We currently support. Share screen.
Okay, let's see.
Right, let's see there.
Nothing yet.
All right.
Oh, there you go. All right, sweet. Here you go. I'm going to add to the screen. There you go. Can you see that, Don?
I can see it.
All right, sweet. Yeah.
Now, thank you. So the question was, when I talk about, and by the way, underneath my name, there's a masterclass, housingwealthmasterclass.com, that you can watch my whole masterclass about this. But it's just a mortgage as the first point. It's not a last resort. Now, if your home could be turned into a reserve fund that was growing tax-free at 6 to 8%, that could potentially surpass $1 million, would you want to see how it works? That's to anybody who's listening right now. I think the obvious answer would be absolutely.
Yeah, 100%.
Absolutely. And
100%.
And so here, the reverse mortgage line of credit, a few things. It's growing. It's non-cancelable. It's bi-directional. Take money out, put it back. It's non-impactful, that if you use it, you don't have to turn around and begin making a payment. It's insured. It doesn't count against your provisional income. Hey, folks, that's a powerful resource, and it's not tied to your home value. So here we go, Phil. So let's take a look at this. We have some homes up here, 200, 400, 600, 800,000 across the top, and a borrower here, age 65. So how much can a reverse mortgage provide for them? So let's look at a $600,000 house and a 65-year-old. It's $234,000. You see that?
Mm-hmm.
Now, Phil, if they don't use that, the unused portion of this line of credit is growing, so that 20 years later, the unused portion, whatever that is growing. You can't make it not grow. It cannot be frozen, capped, canceled, or reduced because of economic factors, the way a traditional home equity line of credit can be. So here's the question. A person who's age 85 and has a line of credit of $701,000, how could that be useful to them in their planning, right? How could that be useful? So that's a question. And that's something I'd be curious to have some listeners say, boy, that could be useful for this, or that could be useful for that. But the point is, you're sitting on your biggest asset. I was at the Baptist church. I was at the Methodist church, Josh, and I said that in the basement. I said, Miss Jones, you got a big asset. And the pastor came and said, we don't use language around like that. And I said, no, I'm talking about a house. But you think about that, Phil. Or anyone,
don't say that to Miss Jones, man. That's not good.
Don't say it to Miss Jones. But to anyone listening, if you have access and it's growing, how can this be useful? Now, I can tell you 52 stories. We'll take a few, but here are a few questions to the listeners. Yeah. Someone says to me, Josh Scanlon, Don, I've got equity in my home. I said, Mrs. Jones, can equity buy you a sandwich? Can equity make what can equity do? You can't spend it. So the question is, if you had a choice, would you rather your home's equity be liquid or locked? Liquid, Don. Would you rather that liquidity be growing or stagnant? Would you rather it be cancelable or non-cancelable? If you took the money, would you rather the payments be mandatory or voluntary? And would you rather have it insured or non-insured? You see, what we have is this growing line of credit for someone who didn't have an existing mortgage, Phil, that allows them to do a plethora of things. And maybe we'll circle back, but you all tell me, if 87% of retirees own a home, how could this help retirement? I'm going to stop sharing here and go back, and we'll come back to that. So, Phil, that's a great question, but I want you to answer it yourself, or those listening. What would having access to your home's equity that's growing, how could that be helpful to you?
Let's see what. We'll wait for some answers to come in here. So that $701,000 is tax free. Don, doesn't affect provisional income.
That's right.
It's pretty obvious how that can be helpful, especially when I don't want to, whatever. I was going to say sequence of return risk. Everyone's worried about that. That seems pretty obvious to me.
Well, we'll talk about that for a minute. Yeah. And for maybe, see, this is out to my network, so there may be some Kentucky folks who, like me, a few years back, 10, 12 years back, didn't know what sequence risk was. Can you explain that?
Are you asking me, Don?
Yes, sir. Yes, sir.
I explained in October 2007, March 9th of 2009, the S&P 500 was down 57%, my friends. You have $1 million portfolio without even taking any distributions. You woke up on March 10th of 2009. That puppy was worth $430,000. 4% rule on $1 million is $40,000. 4% rule on $430,000 is 9.3%. You can kiss your retirement goodbye if you're taking 9.3% distribution rates, unless you're late 80s or something like that. There's just no. That's it. We've all witnessed this, and it's amazing to me how many people forget what happened in 2008. Mm-hmm. That's a sequence of return risk.
Or even, here's someone, Josh. I'm gonna get my marker here.
Yeah.
And so a couple in January of 2022.
Yes.
Had $1 million, folks. I'll put it up here. They had $1 million, and they retired. And at the end of the year, they're going to take out $40,000. They said we believe we can take out $40,000. You see that at the end of the year. But what happened between January 2022 and December? We lost nearly 20%.
Yeah.
So if you had your money in the market, so now they've got $800,000, and they've got to draw $40,000 from that. So here's what happens: they have $760,000. They've lost close to 24%, and that's going to put tremendous pressure on their portfolio. Now, there's a strategy using that line of credit, that housing wealth, and I'll show it to you at some point when Josh tells me, and it becomes absolutely phenomenal what you're able to do if you don't have to spend from that portfolio and allow it to recover. And that's the sequence risk.
Absolutely. Yeah. And Phil says, money I can use, our Phil, who asked the initial question, money I can use for whatever purpose, that $720,000 line of credit. Money you, and then Mary Dawn, who was a kick-ass realtor up in Connecticut, for long-term care, the line of credit you could use for in-home health care, assisted living.
Absolutely.
I actually know about assisted living because you have to sell your house, I guess. But either way, you still.
But home care, absolutely. So my mom will be 90 next month at age 85, and she didn't own a home. And we had a long-term care plan. She was spending about $7,000 per month for care, and we did that for 36 months. So we squeezed that turnip until it was gone. Yeah. And then we had to put mom in the memory care facility. Now, I've done a lot of hard things in my life, but going to different memory care facilities was, and my siblings did the bulk of the work because I'm up north, but that was hard. Having a reserve. Listen, folks, which of you all, if you had access to money, I put it like this. It's an embarrassing story, Josh, but I'll tell it. I got a call from Principal Financial that said, Mr. Graves, you've got money with us, and what do you want to do with it? And I thought some sort of scam.
Right.
And but they knew my name, my social security number. I thought it was still a scam. They said, well, you work for Wells Fargo, and then you had a 401k, and it rolled over to here. And I thought we had gotten all of that out. And once they proved to me I worked for Wells Fargo, I had this, and they had some of that old 401k money. Once they proved to me that that was really true, what do you think my next question was?
Oh, no.
Well, how much? How much?
Exactly. How much is it?
How much is it? It was substantial. I'm embarrassed to say, it was substantial. I'm not talking $5,000 or $10,000, and I'm not so wealthy that I didn't notice, but I thought it was somewhere else.
Right.
If you had an asset that was growing, and someone said that, you've got this asset that's growing that can be used to help your retirement, wouldn't your first question be, well, how much is it? Right? I say, well, it's $711,000,
Right.
or it's $224,000 currently growing tax free at 8%. You would want to know that. So either you could say, nah, that's all right, I'm not going to bother with that. Or you could say, how do I get access to that or turn it on? Folks, that's what the newly restructured reverse mortgage is designed to do. I ask financial advisors, that's where I do a lot of my coaching and teaching, and their clients. I say, Bill, what percentage of your clients at or in retirement do you honestly think would have a need for a reverse mortgage? And if they're honest, they'll say, I'm down 5 or 10%. I said, thank you for being honest. My second question, how many of those clients are 100% certain they'll have a great retirement?
Yeah.
It's like, I said, that's a low number too. Not what you feel, but what they feel. That's 5 or 10%. Here's my third and final question. I say, Bill, if there was a proven resource, listen, folks, if there was a proven resource that allowed those clients to increase their cash flow, reduce their risks, preserve assets, improve liquidity, or even add new dollars back to their retirement savings, what percentage of your clients would want you to tell them about it?
100%. Absolutely.
100%. And I say, now, when you said reverse mortgages, you said maybe 5 or 10% would want to know about it. But when I said this is what it's designed to do.
I'm taking you with me to let my dog outside, so just keep talking. This is the epitome of the professionalism of this YouTube channel. But Barky McGee here wants to go outside and see the brother. Hold on just a second, Don. Keep there you go.
But did you hear that, folks? Five things. I'll say it again. Increase your cash flow, reduce your risks, preserve assets, improve liquidity, or add new dollars back into your retirement savings. Those are the 5 things that the new structured reverse mortgage is designed to do and enhance or improve in retirement income. So 100% of any, I believe all listeners, all advisors would say, yes, I want to know about that. So that's the difference between Fred Thompson and Fonzie and Magnum PI and Jim Gardner. That's the difference between the commercial and then taking time to investigate it for yourself. See, that's the difference of saying, wait a minute, you're telling me I'm living in something that could radically change my retirement outcomes, my peace of mind, the joy I have, eliminate some of the concerns and worry? Yes, that's exactly what I'm saying, that you're living in something that could do that. Now, I know, Josh, this is not for everybody. That's how I've had 16,000 conversations and 3,000 clients, because I'll tell people, I don't think this is the right tool for you.
Yeah.
I don't think this is the right time for you to use that tool. That's part of the consulting that I do. But I always think it's the right conversation to have. Let me show. Can I show my screen again?
Yeah, absolutely, man. And while you're doing that, my other dog just came in. Tell me when you do that. I'll see the link here. All right, there we go. Sweet. Good boys. All right. You got dogs, Don?
No, my last dog bit through my wife's hand. No.
All right, so right here. There we go. Yeah, this is pretty cool.
So folks, take a look at this. And I don't know if I can draw on this.
I think. Actually, I don't know, Don. I think
that's okay. That's all right then. But here's a client, and this comes from Dr. Wade Pfau, one of the America's premier retirement researchers. And he said this up at the top. It says buffer asset. So here's a client that starts out with $1 million. And Dr. Pfau says, in order to make this money last 30 years with all the ups and downs in the market, let's take a look to see how we can do this efficiently. So one of the things that Josh just talked about is sequence risk.
Yeah.
That early in retirement, if there was a way, if the market went down, now he used 1966 to 95, that 30-year period, because it kind of mimics a little bit what we're experiencing now.
Yeah.
So you see these dips here. Where's my, there it is. There's a dip here, big dip here. Now here's what Dr. Faust says. If the year following a negative return, you didn't have to take money from your portfolio securities and you could use another asset, the buffer asset up here, would that make a difference?
Yes.
So here's what he describes. He says, well, it really all depends on when you take it. So I'm going to go back one slide. It says, so here, if you did it one time, Josh, one time, listener, in 30 years, you used your buffer asset, a separate non-correlated bucket of money that the year following a negative return, you say, I'm going to let my portfolio grow back. I'm going to use this other bucket. He says, if you did it one time in 30 years, one time, what would the result be? How much money would you have left at 30 years? Zero? No, he says, depending on what year you skipped, you'd have anywhere between $800,000 and $1.2 million. And then he went on to say, well, what if you did it 4 times? You skipped 4 times in 30 years.
So again, we're talking about skipping when the market is down. We're taking it from
I'm sorry. Yeah. Right. So the market goes down.
Right.
So for example, you had $1 million in beginning of 2022. Yep. Now you got 800,000. Right. So this year, at the end of the year, you say, I'm not going to take any money from that account because I'm going to let it grow back.
Yeah.
And what Wade says is that if you used a different resource, let's say a reverse mortgage line of credit, and you skipped 1967, which means you didn't take money, following that year, 70, 74, 75. If you did it 4 times early in retirement, instead of having 0 at the 30-year mark, you've got $4 million. You see it up here? $4 million left over. And so how did they do that? They used this reverse mortgage line of credit to supplement their draws or to not take anything. And so the question was, did it take anything from the family? Not at all.
No.
It left $4 million without, and where the portfolio never declined, it kept going steady, kept growing and growing. You see, using, and that's the advanced class. That's not quite AP. I was never in AP. But that's for folks, Josh, who tune into you and will view and listen to this, and to say that's a powerful strategy.
And again, Don has talked to 16,000 people. Only 3,000 people went through it. Inherently, it's not for everybody. But man, when the situation dictates, it's like, I just don't understand why people won't at least sit there and say, this could be a good tool to use. And it might not be. But why would you just discount it based on... All right. We got
because they... Listen, if you don't know, it's too much in a 60-second commercial.
That's what I'm saying. Or they'll say, "Oh, Tom Selleck," and I'm like, who cares who's selling it? I don't care. I mean, just I don't literally could care less if it's Tom Selleck or Fonzie, because I don't want to get bash Dave Ramsey here, but I say just because these guys are the salespeople, that means we shouldn't do it. Okay. My man, I can't remember the guy's name, York, PA. He says, is it possible to have a reverse mortgage on a multifamily 3-unit home that he lives in?
Yes. FHA allows reverse mortgages on up to 4 unit properties as long as 1 unit you live in.
Okay.
So that is allowable.
Say again?
I said that is allowable. Yes, you can do that.
I did not know that. So there's your answer there. I forgot your name. My man Harry in Oklahoma, who just changed his avatar. I like the idea of getting a reverse mortgage and use the funds to buy life insurance. Interesting, Harry. That's an interesting idea there. That's for sure. Penelope says, "Dogs."
Can we go back to Harry?
Yeah, absolutely. Yeah, I didn't know if you want to address that. Sure.
Yeah, I want to, Harry. That's because I want to clear something up, and I think that is an excellent idea.
Yeah.
And so I'm going to share my screen again, and I want to share. It's going to look a little different here what I share.
Sorry about the moving around here, Don. Just
when the dog's got a tinkle, dog's got a tinkle. Can't do anything about that.
As long as they're not biting people's hands, that's for sure.
This was a rescue dog my wife wanted, and the kids had been on me. Dad, can we have a dog? And the dog, we went to the SPCA, which normally just has kind of blind 3-legged pit bulls. And but this dog was some sort of a terrier, Tibetan terrier, really good looking dog. But oh man, what we didn't know is that it wasn't a traditional rescue or surrender where people turn dog in. It was rescue because it was in a dog fighting ring, and we lost all of our friends. It went after I saw that dog go after the neck of one of my children's friends. That doesn't seem right. That doesn't seem natural. Then one day it bit through my wife's hand, and I said,
that was it.
Over here, we've got this. Listen, a client's we'll just call it a $550,000 home, and they have a $224,000 line of credit. You all see this column A?
Yes, sir.
Now remember, a reverse mortgage is a Glock, a growing line of credit. So the 224 at age 75 is 335 at age 80 at age 90. So it's growing. Column B, as in boy, and this goes to this insurance question, says, in any given year, Don, if I wanted to turn that into a monthly payment to come to me for as long as I have the loan, what would it be? So I'm going to go down here to age 73. You see this, 73, $320,850. You've let it grow, and you say, I'm going to turn it on. How much could I get coming to me per month? It's $1,706. And column C says, what if I only needed it for 5 years? That's important because when you're most long-term care plans, they don't cover you more than 5 years.
Right.
Remember my mama here at age 85, $550,000 in this line of credit. If you needed it for 5 years, it would have been $10,216 per month that we're sending to you for 5 years. So when we're talking about, and I'll get to regular life insurance, but a question earlier is, hey, what about long-term care insurance?
Yeah.
Sure. Isn't this your long-term care insurance right here? Well, how? You can self-insure for long-term care. Maybe you don't meet the underwriting standards health-wise, but you've got a home.
Right.
If you're sitting on a home that could have grown the home equity $700,000, that's self-insurance. You can co-insure. Maybe you have a policy, but maybe it's not going to be enough. There's something called policy architecture. Listen to this. When you get a life insurance policy with a linked benefit for long-term care or standalone policy, there are 4 things that determine your premium amount. They are how much the policy is going to pay per day, how long it's going to pay it, what's the inflation rider, because you're not going to need it for 10, 20, 30 years. And number 4, what's the waiting period? That is how long do you have to wait before they start sending the checks? So the traditional waiting period is 90 days. What would happen if you said, well, I'm going to wait 365 days?
100%. Absolutely.
Your premiums drop like a rock.
Yeah.
Right? And someone says, well, gosh, how am I going to pay for long-term care for 365 days? That's over here. It's column A. You're living in it, right? What if you change the inflation rider? You wanted it at 4%, but that made your premiums go up. What if you had a 1% inflation rider? Well, Don, how am I going to keep pace with inflation? You're looking at it.
Right.
Column A. You're right. Column A. And so here, you've got the ability to have a long-term care plan. Now, the question, life insurance premiums or any premiums, a reverse mortgage. There's a trash, people. Close that. Let me be clear. You cannot and should not use the direct proceeds of a reverse mortgage to pay for any financial plan or product. And here's what I say. Listen to my words very carefully. My question to advisors, to their clients is, Mr. and Mrs. Jones, if your home could be used to replenish the income used for paying your premiums, would you want to see how it works? Right. See, up here on this line of credit, you see that $1,056. Or you've got a growing line of credit and your insurance premiums are X dollars per month. Well, you've got to qualify and you've got to meet suitability requirements and standards. You've got to be able to show and prove to the carrier that you're able to pay that from your income or your assets. All the reverse mortgage does is say if you would like to replenish what you're doing, you could do that. And so isn't that a wonderful replenishment tool? What about those who say, Josh, a client says, I want to get out of the market. I've got $500,000 here, and I'm too old for all of this.
Yes, exactly.
I'd like to get at least take half of it and put it into an annuity or fixed income. That's great. I think that's a proven strategy. But all of a sudden, the client says, well, what am I going to do about liquidity? What if I need the money? And I had an advisor say, well, you can get 10% penalty-free withdrawal. And he says, well, if I didn't use it for 5 years, can I get 50% in the 5th year? And he said, well, no, it's only 10% of accumulated value. And that client, instead of implementing a full safe money strategy, just rolled over $100,000 because of liquidity. Listen, folks, column A is your liquidity replacement vehicle, not an SUV, but an LRV. So if you've got money in the market and you're concerned, and someone like Josh says, well, we can do something that allows you to do this, here's your liquidity.
Exactly.
The reverse mortgage is your liquidity replacement vehicle. So you can have some money in the market that can beat inflation. You can have some money in fixed income vehicles that will be protected and have some sort of growth. And you can have liquidity all right here. So you can have your cake and eat it too in a lot of ways. So that's where reverse mortgages can begin answering the long-term care question. Because here's your long-term care plan. You're living in it.
Right there. Absolutely.
It can answer your life insurance.
And like you said, if you want to follow up with a secondary long-term care specific policy with a 365-day, basic deductible without a 5% compounded inflation, you know what I'm saying, Don? And even you can reduce the long-term care daily benefit too because you got the first year covered. That's going to make your premiums a whole lot lower. It adds a lot of there's a lot more power in having a secondary source where you can combine the products, Don. You know what I'm saying? To say it's like, man, 1 and 1 equals 3 in this regard a lot of times.
That's right.
Just real quick, Don, not to interrupt, but I tell you, man, Harry, like secondary life insurance, if literally another thing that boggles my mind, if leaving a legacy is point number 1 for people and we're not looking at secondary life insurance, that doesn't make any sense to me. I'm like, man, you got to look at, and I don't want to get too deep in secondary life insurance, but this is the problem with not just the anti-reverse mortgage, but the anti-annuity people too, even the anti-life insurance, is they look at everything in this one thing of equity returns. I'm like, man, you don't understand. If we can leverage our home to replenish the cost for secondary life insurance and allow our equities to hopefully grow, 7% clip, it doubles every 10 years. We don't know that's going to happen, but we know if we have a secondary life insurance that's going to leave a legacy tax-free, we're taking out some of our home and we're still getting the line of credit growing as well. Man, there's so many just things that are flowing together so nicely. If people could just see that as opposed to equities all the time, I'm like, man, there's more than that.
But Josh, isn't it true? Sometimes you just don't know.
Absolutely.
Or you've heard the Uncle Junebug stories we talked about earlier. You read something in the paper, or you listened to that person you mentioned earlier. And I want to give a case study that really comes out of that person. See, there's an article that a buddy of mine wrote that identifies 5 lies that person told. And if your audience wants to get that, I'm happy to send it to them. And but let me show you a case study.
Yeah.
And you'll see the kind of the concept that this person talks about. So
there you go.
Here's Carol. Carol's retiring. She's got $500,000 in an IRA, and she believes that she has to take out $30,000 initial withdrawal rate and adjust that each year for inflation. I think that's a bit aggressive, but nevertheless. 68% plus of retirees have a mortgage or some sort of mortgage payment coming into retirement. She has a $200,000 mortgage, and her monthly principal and interest payment is $1,500 a month. So, folks, this is very common. This is a common client.
Talk to a person just like this today, Don. Absolutely.
So if you listen to that fella on TV and radio and podcasts, he'll say all debt is bad. We don't want any debt. And I would say, but Carol's already in debt, and she's in danger of running out. What do you think she should do?
Exactly.
He may say Carol should sell her house and move into an apartment.
Right.
You want to see someone cry big crocodile tears fast and in a hurry? Tell them that. Tell them to move into their daughter Tracy's spare bedroom. See what happens. See. Now, isn't it true that most retirees want to live a life of some independence and not being looking to the children to support them?
An age in place, Don. They want an age in place.
So, if Carol listened to the TV folks, she would say, oh, no. Or she goes and tells her kids, I'm thinking about a reverse mortgage. They say, oh, no, Mom, that's dangerous, spooky. And we knew someone who had an aunt, had a cousin, had a grandmother, got a reverse mortgage. Her dog died, and she grew a beard. I said, well, she already had a beard, and her dog was like 28. So Carol here gets a reverse mortgage. Folks, look at this. And the reverse mortgage makes $224,000 available to her. So the first thing the reverse mortgage has to do is pay off the existing mortgage.
And that goes to one of the questions someone asked too, Don, real quick. He said, can you do it on a secondary? I forgot what he said. But so no, the reverse mortgage has to be primary. It can't be subordinate, just FYI. So just someone had asked that question. So keep going.
So the reverse mortgage made $224,000 available. So first thing it did, it has to be a first mortgage. So we got rid of her $200,000 mortgage. Folks, what did that do for her? That eliminates her $1,500 a month after tax payment. Yeah. Now, why do you say after tax? Because she's taking out $30,000 from a taxable account, which means it takes her about $1,900 out of that account. After she pays state, local, and federal, she nets $1,500. Now, let's take $1,900 that she's keeping, multiply that by 12. She's going to retain $22,000. So she no longer has to draw out $30,000 a year. She only has to draw out $8,000. That's a 1.6% initial withdrawal rate. That means her dollars are going to last her 10 to 14 years longer. But not only that, remember the Ronco rotisserie chicken commercial? But wait, there's more. Not only do we extend her portfolio life savings, make her sleep better, we minimize her taxes.
There you go.
Because that money is impacting her provisional income. That's going to impact her IRMA, Part Medicare, Part D and B. And possibly we even get her in a lower tax bracket. Did you see that? Did you see that by having her? Because here's the question. Folks, here's my favorite word. Carol is already, can you say that with me? Already making a monthly mortgage payment.
Yes.
And we simply said to Carol, since you're already doing this, what could retirement be like if you didn't have to make a monthly principal and interest payment? Oh my gosh, it's absolutely transformed her life. I'll tell you about, and these stories are all true, by the way, names are changed, but there was a fella who had $5 million with Merrill Lynch. And his advisor called me, and he says, my client would like to look at a reverse mortgage. But, Don, I've got to be truthful with you. I think these things are garbage. And I poo-pooed, and I told him they're not for you. I said, so why are you calling? He said, my client is a retired CEO of a large multinational pharmaceutical company whose name you would know. He's got $5 million with me. He's got a $4.5 million home in Stone Harbor, New Jersey. He's asked me for 4 months. I poo-pooed. He says, if you don't do it, I'm going to go and get an advisor who will. I said, what are we trying to accomplish? He says he wants to get a life insurance policy that's going to be multi-generational and estate planning, help his children and grandchildren. And the premiums are $15,000 per month. Now, I don't sell life insurance,
Right.
but I would think for those who did, that's a pretty good deal.
Yeah.
So I said, okay, that's $180,000 a year in premiums.
Yeah.
Why don't you just take that out of his $5 million? He says, no, that's going to cause taxation. That's going to reduce this. That's going to do this. I said, okay. He said, well, Don, he seems to think a reverse mortgage could help. I said, let me run some numbers. So he had a $4.5 million home. He had $2.1 million in mortgages and liens against the property. Every month he's paying, listen, $21,000 per month in principal and interest. Now, he was a high net worth individual, and so it wasn't terrible, but I said, all right, he's paying $21,000 a month. So just like this example with Carol, we did a reverse mortgage for him because the reverse mortgages go up to homes $10 million, folks. So we did a reverse mortgage for him. It made $2.2 million available. That paid off what he owed, $2.1 million. And when we did that, Josh, we freed up $21,000 a month in cash flow. He was able to then take $15,000 of that to pay the premiums for his life insurance. He still had $6,000 left over. You see, because his
tax free.
And so now he's developed a multi-generational estate plan using life insurance, created cash flow for himself, and the advisor still got to maintain the portfolio. So the family gets the apple tree and the orchard, the boat, the dock, and the insurance, right? And that's because the advisor had to go beyond what he thought to what was actually true. And when that happens, it becomes pretty dramatic.
Well, I'm saying.
Even when you tell folks, the listeners or those who will be listening later, I say, here's my question, Mr. and Mrs. Listener. I'm just going to call you Fred and Wilma. Fred and Wilma, I see that you're already, that's my word, you're already making a monthly mortgage payment. I'm curious. If you had a choice, would you rather that payment be mandatory or voluntary? What would you choose? Now, Wilma, voluntary. They say, duh.
Right.
Voluntary. I ask them, I say, me too. Why would you choose a voluntary payment? And Wilma says, well, gosh, the uncertainty in bedrock, things are just out of control here. Said freedom, flexibility, control. We can spend less, save more, sleep better. And Fred just nods his head. So I said, so Wilma, if we could eliminate your mandatory monthly mortgage payment and make it voluntary so you could sleep better, spend more, and have freedom, flexibility, and control, would you want to see how it works? Now, Josh, to your listeners, I want you all to answer this question honestly. If you're retired over the age of 62 and you're a homeowner, and you have a monthly loan payment of any kind, did you know that that's a voluntary payment, that can become voluntary? It doesn't have to come out of your account the first of the month. Has anyone ever told you there's a voluntary payment option available for you? I bet you didn't know that. Because
no one ever tells them, Don. That's why, because they're like the Merrill Lynch guy.
But there is. See, the newly restructured reverse mortgage can take your mandatory monthly mortgage payment and make it a voluntary one. And we can do some other pretty dynamic things with it that you've never even considered. Now down here, there's my masterclass, Housing Wealth Masterclass. It's under my picture here. That's a 47-minute masterclass where I unpack 3 basic principles about the reverse mortgage.
And that's for customers or for financial advisors, Don?
It's for both.
Okay, cool.
It's for both. But it certainly was designed for the consumer in mind. But 3 points. It's just a mortgage where we cover the basics. It's not a last resort. Right? Some people say, don't do that reverse mortgage until pigs fly and fat women sing. I'm from Kentucky. I've seen both. But I talk about this line of credit. And I said, if you were saving, if you had to do it over, would you start saving $10,000 a month at 25 or would you have waited to 55?
Yeah, 100%, man. Earlier is better. Absolutely.
Number three, it's more than a television commercial. And that's where we unpack 5 very basic strategies. I've just given you one here. This is actually from the course. So Housing Wealth Masterclass. And at the end of that, you can sign up for an assessment where we look at real numbers. But let me show you. Let me show you this voluntary payment, because here's something that just, people don't understand this, Josh Scanlon, but I'm going to show you because you said.
Well, he's bringing that up, guys. 401k Dexter said your home cannot. I just want to be clear. The reverse mortgage has to be cannot have a secondary mortgage. It can't be secondary. So your home doesn't have to be paid off. If it has a mortgage on it, though, that mortgage will be replaced by the reverse mortgage. Just FYI, it cannot be.
So does it? Most people I talk to, their home is not free and clear.
Exactly.
They're doing the reverse mortgage to move from a mandatory payment to a voluntary one. So let's look at this client right here. I want to show you. They've got a $500,000 home and $100,000 in mortgages and things like that, and they're paying $1,000 a month already. That's our word, already. Yeah. So they did a reverse mortgage. The principal limit, that is, how much did the reverse mortgage make available, Don? $200,000. From that, we paid off their existing loan, and there were some closing costs tied into that. And this is the outstanding balance, right? Now watch this. When we subtract the outstanding balance from this principal limit, we get something called the line of credit. I'm going to kill 2 birds with 1 stone in this. Don, what do you mean the line of credit grows? Let me show you. So this principal limit, that's a term for the reverse mortgage world. That just means what we made available. The federal government calls it the principal limit. It's going to grow. It never stops growing. It never stops growing. The outstanding balance is what you owe. That's going to grow as well. And when we subtract one from the other, we get what's called the line of credit. So let's watch this. So the first year, the principal limit grew to $210,000, 5%. Your outstanding loan balance grew by 5%, $110,000. And when we subtract one from the other, your line of credit grew from $95,000 to $99,750. That's how the line of credit grows. And it's going to continue to do that, right? Now, this client says, Josh, and those listening says, well, you're already making a monthly payment. What if you continue to do that? So they say, okay, I'm already making a $12,000 a year payment. I'll just do it over here. Yep. So notice what happens. So their loan balance grew to $110,250, but they made a payment of $12,000. So it reduced that. And what happened to the line of credit?
Oh, man.
Now it's $117,750. So the client, listen, folks, they keep making a monthly payment like they were already doing. Yeah. And then out here, year number 11, their loan balance has gone down. So it's only $9,000, but their line of credit, what's accessible to them in the reverse mortgage, is $332,000. These folks did something. I don't want you don't have to stop your payment. Just change your partner. Now watch, it gets better. After year number 12, I say, don't pay it off. If you pay it off, they're going to close the loan. So just pay it down to $125 and leave it alone. So year number 13, they're no longer making any payments. Their loan balance is $132. That's what they owe the reverse mortgage. But their line of credit continues to grow.
Yeah, that's crazy.
So now, year 21, it's $556,677, $864,000. So how did this client, we'll call them Barney and Betty Rubble, how did Barney and Betty go from making a monthly loan payment that they're already doing? They had to do it. Many of you are already doing it. How did they turn something they're already doing into a financial picture that they can have a reserve for expenses, enjoyment, emergencies, that they can do manage sequence risk, that they can have a long-term care plan, that they can give more, save more, that they can do life policies for their children or grandchildren? How did that happen? They simply had to understand how the reverse mortgage works and take a little time to go beyond the TV commercial and to find out what's actually true. See, once you understand this, now I don't have a lot of hair to catch on fire, but once you understand it, oh man, your hair could just catch on fire with this thing.
Absolutely. Don Mary says, "Is there? I'm not sure what she means. A monetary cap? Is that like the value? It says $10 million is the most they'll lend. Is that what it is? Or I think it's what.
So the reverse mortgage, and so Mary, I like the way you spell your name too. And so if you weren't here in the beginning, the amount of money reverse mortgage makes available is a triangle. This is not the Jay-Z Illuminati sign. Don't be afraid. That's just a triangle with my hands. And it's based off the age of the youngest borrower, the value of the home, and the expected interest rate. And that makes a certain amount of money available in the middle of this triangle, which is a portion of your home's value. Typically right now, age of the youngest borrower minus around 32 gives you a percentage of what you can get. All right. Now, HUD says age, value of the home. Well, HUD says we're going to only value the home up to about $1.1 million. That's our cap.
Okay.
And so if you've got a home that's $1.5 million, and when we do the formula, HUD says, nope, it's only worth $1.1 million. And so that's your home value. When you move into the jumbo reverse mortgages, which are for age 55 and above, not every state has it. Now the home value can go as high as $10 million.
Gotcha.
And you can borrow a portion of that. That's how a person, he had in La Jolla, California, he owed the IRS $7.1 million. He had $45 million in assets. So between his accountant, attorney, and financial advisor, they're trying to figure out the best way to fix this IRS problem he has. And so they said, well, call Don Graves. And they called and said, Don, can you make $7.1 million available to our client? I said, I cannot. They said, what can you do? I said, well, he's got a $10 million home. I can make about $4.1 million available. Here's what I suggest. Take the $4.1 million and negotiate with IRS. Tell them we'll give you $4.1 million this year.
Right.
And next year, you give them the other $3, either from the portfolio of securities of $45 million, or they were rehabbing a hotel that he owned. The rehab will be finished, refinance it, do cash out, and pay them the rest. You can even pay back the reverse mortgage. And so we do this with folks who have a lot of money. $45 million is a lot of money. And a woman yesterday didn't have but a little bit of money. But the strategies are far and wide. And
what do you think, Don? I don't know. It's a good question. I'm glad he asked this. Paul says, Don, is reverse mortgage appropriate for an elderly person, single, age 82, with a terminal illness that needs to tap equity to pay for care? He asked about a HELOC. HELOC's out of the question, most likely. But what do you think of that for a reverse mortgage here?
Sure. Keep that on the screen.
Yeah,
if you Paul, that's a great question. And so it goes back to the goals. A reverse mortgage is not always the appropriate conclusion. I do believe it's always the appropriate conversation.
Yes.
And so an 82-year-old, my question is, where's the best place for them to age? See, my mama's 90. She had dementia at 85, and she wanted to age in place, age at home. So we spent $7,000 a month for 36 months until we ran out of income. And then we moved her to a memory care facility. So my question is, what's the best place emotionally and medically for the 82-year-old to live? Usually that's at home for them. That's typically the best place. Number two, if that's the best place, how do you get money to pay for it? So someone says, well, I'm gonna go get a home equity line of credit. I said, you could do that. Number one, will they qualify?
Exactly.
82-year-old on limited income. And because lending is no longer asset based, they don't care if you got $3 million in the bank anymore. They want to see if you've got income flow. So, and two, you're going to have to start making a payment as you take those dollars out. And so some people say, well, I'm going to get a cash out lump sum line of credit, put it over here, and then we're going to make the payments on that from this big bucket of money we have. And at some point, it's self-cannibalizing. I said, that's dangerous because at some point it's going to cross over. and that bucket's going to drain, and your payment's going to be more than you have in the bucket. I said maybe a better alternative would be to at least find out how much would a reverse mortgage line of credit make available, and to see what it looks like to have care from that.
Exactly. What I'm saying.
The question that came up just like this week to the caller, Paul, was that, hey, Don, what if we spend it and Dad needs care? I said, but then if you had a home that's $500,000, you had a $200,000 reverse mortgage line of credit, in 2 years you spent it all, right? So now Dad's got a house that's $600,000. He owes me $300,000, and you sell it, you still got $300,000 to do private pay care if you want it. So you have to determine what's the best place for Dad to age emotionally, environmentally, economically. What's the best place to age? Now, sometimes, Josh, with unscrupulous children, certainly not the one that's there, the children, I've got a family now, family of 4. Mama's 96. She's got plenty of equity. She needs care. But 2 of the siblings are so greedy and evil that they're saying, well, we don't want to do the reverse mortgage because that's going to take away from us.
Right.
And I tell folks, listen, now you don't want me as your consultant if you're that type of child.
Right.
And because when I see a child that's of a certain age sitting on the couch watching Ricky Lake reruns and saying, Mama, did you finish washing my underwear? Sometimes I just have to leave. I gotta, because I know, I'm going to say something offensive here. And yesterday, this lady, a beautiful, beautiful, godly woman, she had a wonderful house, had 12 acres, and her son said, Mama, sell it to me and you can do something smaller. And she sold that son the house for half of its value. And he moved her into a little condo. And now when she needs some help, and she's only on Social Security, see, she could have done a reverse mortgage on that much bigger property. He won't help her.
Yeah,
he won't help her. And I told her yesterday, I said, you know, you may not want me as a consultant. You certainly don't want me to talk to your children.
Nice.
And but I know that's not most folks. So the answer is yes. A HELOC for me would not be an alternative for.
Not for that lady. No way. Theo is 66. His his better half is 60, Don. He can't get a reverse mortgage until she turns 62, he asks.
Theo, the reverse mortgage makes money available based off of the triangle, age of the youngest borrower, value of the home, long-term interest rate called the expected interest rate. And so in 49 states, one spouse only has to be age 62. The other only has to reach age 18. Mm-hmm. Alabama tried to get 14, but Congress denied that. Now, the one state that says nope, both have to be 62 is the state of Texas.
I was going to say, I bet Texas. Now,
DFW, I don't know what that means. It could mean Texas, Dallas, Fort Worth. I'm in Philadelphia area, so we have no love for the Cowboys, but I did growing up. So no, Theo, if you're in 49 other states, you can do it. If you're in Texas, both have to be age 62.
I was thinking that might be the case. Don, my man, says right here, what does the upfront process look like? I'm assuming their inspections. Is it similar to a real estate closing?
Sure, Tom, great question. For a person, I'll just use some of my clients with me. Someone says, Don, I'm interested in knowing about the reverse mortgage. I don't want to be sold. Yeah. I say, go underneath my name and go to housingwealthmasterclass.com and watch it. And you can just watch the first 7 minutes and tell this is not for me. But at the end, you say, okay, I'm willing to take the next step. Fine, we'll do a consult. I get the privilege now. I've got a whole team across the United States, and I give leadership to a team about 200 with the Fortune 300 company. I don't mention their names, as I said, Josh.
Right.
But once a person consumes some content, I do a consult, so we look at the numbers. We say what strategy works best for you. What are you looking at? And at that point, there are three primary steps. Number one, we send you out a proposal. HUD requires us to send you a proposal. It's 96 pages. You don't have to print it, but you have to receive a proposal. Number two, you have to call a counselor. So there are 400 counselors that do Heckum, home equity conversion mortgage or reverse mortgage counseling. You've got to call them, have a conversation, typically by telephone. And their job is to make sure that you're not being fooled or you know what you're talking about, you don't have dementia. And then number three, you fill out an application with our team and I. That's typically done by DocuSign. After you complete that, it's 6 to 8 weeks, a little shorter these days. We order the appraisal, we do the inspection, we dot the I's, cross the T's, pull your credit, make sure you haven't lied to us, you're not doing anything fraudulent, X, Y, and Z. And then the loan closes and goes to settlement right there in your living room. That's the process, Tom. Thank you for that question.
Good stuff. I'm not. Craig asked when would be not the right time to take it. I don't want to answer that just because you'd want to. There's lots of different right times not to do it, Craig.
Listen, let's put it up.
Okay.
Let me because that comes up. Don, when is it not a good time to do a reverse mortgage? So I said there are 5 things the newly restructured reverse mortgage is designed to do. And if I walk through these 5, you say, I don't have an interest in any of that, then it's not the right time for you to do it. Increase your cash flow, reduce risk, preserve assets, improve liquidity, or add new dollars back into your retirement savings. If there's an opportunity to turn your home's locked equity into liquid that's growing, and you say, I don't have a need for it. Why? Well, I've got $10 million. Okay, listen, that doesn't matter to me. You can have $45 million, but do you want to spend it? If there's a way to leverage that you have more, you would do it. I tell people, if you're planning on moving in the next 5 years, I would not do a reverse mortgage. I would do a reverse for purchase. So a bad time to do it or not the right time? Don, I'm planning on moving. I'm going to tell you, let's not do it right now. Let's look at the reverse for purchase. Yeah. Don, I've got a child with special needs in the home. And I said, that's not a reverse mortgage problem. That's a death problem. Because at some point you're going to die, and what's your special needs son or daughter or sister going to do when that happens? Yeah. But I understand you want to be cautious with that. And so those are typically kind of the 2 things. But I don't think it's the conclusion to every matter. I think it's a conversation that we all must have. So thank you, Craig. I think that's a great question.
It's 100%. But having a conversation is still worth it. That's the issues. Just because I don't know, having a conversation about these kind of things makes sense. And don't be. I'm not talking to you, Don. I'm just saying, don't be so secure in your financial situation that you think I don't need this. Well, you don't know, man. You might. It might not work, but it might. My man Philip, what about using reverse mortgage to delay Social Security? I want to remember when Don was pointing out Carol. Who got her reverse mortgage paid or her mortgage paid off by taking the reverse mortgage. Folks, remember, if Carol's on Social Security, now she's only pulling $8,000 a year from her portfolio as opposed to $30,000. She pays no taxes because reverse mortgage is not subject to provisional income. So this is a good question. I want to kind of make sure we get through the. Okay, I guess that was it. So
yeah.
There's a lot of different strategies in this, Philip, in terms of using reverse mortgage to. Anyway, Don, if you want to, there's tons of different things to use reverse mortgage to delay Social Security, to use it while you're taking Social Security, to live off Roth. There's a million different things. But Don, if you want to,
absolutely. Oh my gosh, let me. I had it up there on the screen, but I didn't explain it, and I'm going to share my screen again.
Okay. There you go.
All right, good. Let me
Jack and Diane.
Some people start to notice. Now, listen to this. Yahoo Finance had this article. It says 14 key signs you'll run out of money in retirement. And I said, wow, that's a great list. So I put all 14 on the right-hand side here. And I did this line of credit. If you've been watching or listening, you've seen this. And now I want you to know this. Here's a 65-year-old. And they say, Don, I want to delay they were going to take their Social Security in March of this year. But their advisor said, if we can delay your Social Security till 70, it's going to grow at 8%. Yeah. They had an old Prudential annuity that had a vesting schedule growing at 7%. Yeah. And they thought they could manage their IRA to grow at 6 to 8%. And they said, Don, we just need a 5-year bridge. So notice over here, column C as in Charlie. A $224,000 line of credit produces $4,160 a month for 5 years. I can tell you their Social Security was not $4,160 a month. They only needed to replace because they needed the income. So we could do a payment of $2,000 a month and still have some money in the line of credit. And what they did, that these advisors put it in their special software, I think it was called eMoney. Yeah. And they said if we can shorten their glide path from 30 to 25 years and create this bridge, you know how much money is left in the orchard? $665,000. $665,000. And you underestimated your life expectancy. You didn't plan for high healthcare costs. You didn't take inflation into consideration. You didn't factor big ticket items. You changed your spending. You loaned your kids money, spoiled your grandkids. You didn't take taxes into return. See, that's Jack and Diane right here. Yep. Jack and Diane have $1,000 in qualified money. And the old adage that I'm sure Josh uses all the time, when is $1 million not $1 million? When it's in an IRA or 401k, because Uncle Sam owns it. But notice here, we said, well, what if we take that $1 million and do a structured Roth income conversion? Let's just take $100,000 every year, consult your advisor. And so what happens is this line of credit, notice $224,000, it's growing. And that's 4.5%. It's growing today about 8% at the time of this recording. So the line of credit grew. And then we took some of that growth, $24,000, to pay the taxes on the Roth conversion. Mm-hmm. And we kept doing that year after year after year. So what happens, at 10 years passed by, we've converted all $1 million from forever taxed to never taxed, and we still have access to this growing line of credit. Yeah, nice. You see? And so when folks, and by the way, what you're watching here, these slides come right out of the masterclass. And so I just expand on them a little more. But the bridging Social Security, getting yourself in a lower tax bracket, protecting from IRMA increases, and really some wildly fantastic things that we will cover. But it's all in there. I'm going to drink some water, Josh.
Yeah, well, I think we're that's good stuff, Don. We got an hour and a half in. I think we've had you for long enough, man. Just because I want to make sure we respect your time here. But so the housingwealthmasterclass.com, is there a fee to register?
No. This is a complimentary course for consumers or advisors. And what we ask for at the end, I'll say, listen, if this made sense to you, I want you to use our services. Is that fair, Josh? I think that's fair.
Absolutely.
So I don't want to give you the 11 herbs and spices and then you go across town somewhere. I want you to allow me to do the consultation, right? And when we do that, an easy way, and that's at the end of it. And then I get to send you some free resources and help you. You've heard me. You've listened. Some of you are going to review this. It'll be my pleasure. So we've had a great time, Josh. I've got a 1:30. I got a call coming in.
I'll let you go, Don. God bless, man. I'll put links, folks. I'll stay on for another 20 minutes or so. I'll let Don get off here. I will put links in the show notes for Don's stuff. You're a good man, Don. I don't care what they tell you from Winchester, Kentucky. Yeah, you're all right by me, man.
Thank you, my brother. God bless.
Hey, thank you, sir. We'll see you, man. Thank you, sir. All right, so that was Don Graves, everybody. Don just kicks ass. Love that guy. I love when he uses Fred and Wilma. And hey, what do y'all think? Any questions that you got? See, personally, what I'm gonna do. I'm 52. When I'm 62 years old, I'm not gonna be in this house because I'm gonna get the heck out of Fulton County. I'll tell you that right now. Is I'll use a reverse mortgage for purchase, 100%. I think, or I might just wait till I get in the home that we're gonna buy downsize, and then get a growing line of credit. Dudes, that growing line of credit is worth this freaking. I mean, I'm just sitting there thinking, I don't even care if it's only 5%. You're getting let's just say you got $100,000. I don't care what it is. You got $500,000 house. Hey, right on, man. Look at our no Marcuzzi. Right on. Man, I'm just telling you, I'm sitting there thinking, if you could get a growing line of credit at 5% a year, just for simple, we'll just say it's a simple interest at 5% a year. And let's say you got a $500,000 house, they give you $150,000. And that puppy just grows at 5% a year. And then like he said with Wade Pfau when Wade Pfau was talking about it, if you can, just like the barbell, if you take the money out of the reverse mortgage when the stocks are down, it reduces, if not eliminates, the sequence return risk. And then on top of it, you still have money that's still growing. Whatever's left is still growing. Do you see that one chart he did where the guy he paid he took the line of credit, he was paying $1,000 a month against his mortgage that he still had, and the line of credit was still growing even while he had a debt against it. I'm like, because they take the lending amount minus your debt, and whatever's left, that's their line of credit amount. I'm just like, dude, crazy. And I'll tell you what, too, my man Harry made a good point with life insurance. And again, you can't, it's called financing. You don't want, what do they call it? Financing surgery. Remember, whenever you're doing a life insurance thing, they'll say, is this financing? I forgot what they call it. Not company-owned life insurance. That's COLI. Some kind of financing. I forgot what it's called. Bank-owned. It's bank-owned financing. Anyway, you don't want to finance the life insurance via your reverse mortgage, but you're basically paying yourself to have the cash in which to buy a life insurance component. If leaving a legacy is a big deal, I'm telling you, man, second die life insurance with a reverse mortgage, maximizing your Social Security. You still got some equities. I mean, you're just crushing equities in case the market can. If you get 7%, yeah, I appreciate y'all being here for sure. A 7% average rate of return on equities. That's doubling your money every 10 years. You got some freaking second die life insurance that you leave as a legacy. If legacy planning is priority number one, you got your freaking barbell and your reverse mortgage. You still got enough cash to pay for the roof and all that. But, man, it's like so many ways to make this happen. And I'm sitting there thinking, if you're look, I was talking to these people from the villages today. They moved from Alabama to the villages, and they flipping love it, dude. You can see the woman's face. And she's just like, and she took me a tour on a computer around the house. And I was like, man, this crushes. And I don't know if I can handle living down there, but I still like the fall. But I mean, she quit her crappy old job. And I say crappy old job, but she quit her job. She's 61, 62, something like that. About 62, something like that, 63. I can't remember. And your life is good. Life is good. They didn't do a reverse mortgage, but I'm sitting there thinking, because they have a mortgage still, and they probably wouldn't qualify for a reverse mortgage because I think they owe more than 50% loan to value, but I can't remember. But in a few years, you take a reverse mortgage, you pay that mortgage off. Yes, you still have a debt and it's still accumulated, but now you don't have to freaking make the money to which to pay the mortgage. You don't have to pay the tax on that money. Oh my God. I don't understand why it's like got to be all this or that. And so my man Thomas, I was like, yeah, dude, if you think the equities are going to give you historical rates of return, you would want to do a reverse mortgage even more. I mean, think about it. If you think you're going to get 10 to 12% a year in equity, probably. You don't want to touch those equities if leaving a legacy is priority number one. That means you're doubling your money every 6 to 7 years. And then they get the step up basis. So if you think the equity market is going to go historical, you would want to do a reverse mortgage because you're going to double your money every 6 to 7 years. It's crazy. If you think the markets aren't going to do well, you're going to want to do a reverse mortgage in case the markets go south. It's like, this is weird to me how many people they hear the thing reverse mortgage, they immediately say, no, evil. They put it, what do you say, Uncle June or whatever? Uncle June did a reverse mortgage. Uncle June got put out of his home. Thus, logically, people say the reverse mortgage put him out of his home. Both things are true. Uncle June did a reverse mortgage. Uncle June got Junebug, as we call it. Uncle Junebug got put out of his home. Both things are true. But that doesn't mean the X led to Y, which equals Z. It just means, yes, he did a reverse mortgage. Yes, he did get put out of his home. The reverse mortgage did not do it, though. Yeah, I'd never say never have to worry about the markets anymore. But because, I don't know. I mean, you might. I tell you, though, man, and the best time to get a reverse, I mean, for me, the growing line of credit. Yeah, right on, dude. I didn't. Hell, Craig, I thought life insurance was evil too. I follow these guys on LinkedIn. They say, I like them. They're like, have you ever known a person that had over $1 million in life insurance? I said, I have 100%. Had a client. He had $3.5 million cash value life insurance, guaranteed at 5.85% a year. Tax equivalent yield is about 8.5, 8.75% because he's in a high tax bracket. Guaranteed $5.5 million death benefit because you have to keep that corridor of cash value in life insurance. I said, dude, you're going to tell me, and I mean, could stocks do better than 8.5 tax equivalent yield? Yeah, hopefully, but that's no guarantee. His life insurance is guaranteed by USA. And I'll never forget that. I had no clue. No clue. I was thinking, no, buy term and invest the rest. I said, I saw that with my own very eyes. I said, man, what else have I been missing here? You see what I'm saying? I mean, we just didn't know. I 100% too. That's the issue of why I like to bring these things to the table for people to say, I did not know. And then when you do know, you're like, well, if I didn't know that, this is where it happened to me. If I didn't know that, and I didn't know that, what else did I not know? Moon landing. I don't want to say that. I don't want to put Don Graves into my conspiracy theories. But anyway, that's the point being is like, once you are made aware of things you previously took for certain that you did not know, you're like, was I being arrogant in my knowledge? And probably I was because, it's easy to forget arrogant. Like I know everything. And then you start looking at a different side of the story. You're like, oh man, I did not know that. Anyway, so for me, the issue for me is, do I do a purchase more? So my thought process is I probably will sell the house, get enough proceeds to buy our house wherever we move. You know what I'm saying? Huntsville, Alabama, Shenandoah Valley. I don't know. You know what I'm saying? Just North Georgia. And then I'll start the line of credit on the reverse mortgage to get that puppy going. I mean, I'll start growing line of credit, growing line of credit on the reverse mortgage to get that puppy going. It's like somebody said, you invest $10,000. You'd rather invest $10,000 today than wait a year from now. Wait 2 years. Wait 20 years from now. You'd rather plant an apple tree today than wait 20 years. Same thing, reverse mortgage. You get a growing line of credit. I think that thing is so valuable, dude. I think it's so valuable. All right, you guys got any thoughts, questions, comments? Let's see what the markets are doing. Yeah, right on, Pam. I appreciate y'all again being here. It's fantastic. Don Graves kicks ass. Just a good guy, man. I like him. He's not here to sell you anything. And the people I've talked to, I've sent to Don. I don't get any money from the guy. Nothing. I wouldn't accept any money from him anyway. He wouldn't offer it to me anyway. But the people I've sent to him, they speak highly of him. You know what I'm saying? So, I mean, obviously that's, no one's going to say, you sent me to Don Graves and he sucks. I haven't heard that ever. So just because people I sent to him speak highly of it doesn't inherently mean. Looks like the markets are bouncing back up here today. That's interesting. So they went down for a little bit, bouncing back up. I figured they'd have a pretty good day in the markets today. It's still the 10-year treasury is still below 3.5. That's crazy. Dude, second die, Harry, I tell you, man. When you start looking at the IRR, internal rate of return on second die life insurance policies, man, if you got the cash flow to pay for one. Now, remember, a second to die life insurance, I don't want to get too deep in this. We're not trying to maximize cash value. That's a mistake, I think, a lot of agents, because cash value is very seductive. The whole point, you want second to die life insurance almost like a term. You want to minimize the cash value because the kid isn't going to get the cash value. The kid's going to get the death benefit, the survivor essentially, or the beneficiary. So we want to have, it's almost like it's like a term policy with just a little bit of cash value to make sure the policy stays in force. Like you don't want $400,000 cash value in a second to die life insurance policy with a $700,000 death benefit. That's just a waste. We want $20,000 cash value with a $700,000 death benefit. That's how you want it. And I'll do another video on this one time. I wish I had access to. 100%. Inflation came lower than expected. They keep hoping for the Fed to pause. Yeah, they're going to reverse without question. they'll probably see the issue is this again sucks that the Fed's going to think they have a victory lap. PCB, I don't know what that is. What does PCB stand for? The Fed thinks they control. It's almost like that CO2 silliness. If we can turn the knob on CO2, temperatures will naturally drop. It's freaking dumb. Same thing with the Fed. If we turn the knob on raising interest rates, inflation will naturally go down. It's dumb. What's the price of gas? What's the price of oil? What's the price of electricity? What's the price of energy? It's dropped. Why is it dropped? Because Russia is freaking crushing, man. That's all there is to it. And as such, and remember, how much LNG are we exporting to Europe now? It's nuts. And as such, the price of our products that we buy on a daily basis have gone down for sure. And part two, you can't overlook economic activity. Economic activity is without question slowing down. I'm telling you. It might not be everywhere. Florida is not. Texas, I hear people saying it's not. But, I did that video yesterday, and a lot of people are saying it's slowing down big time. And, who knows? But economic activity is a slowdown because the interest rates increase? No. Does it slow down because the consumer doesn't have as much spending power? That's it right there. The consumer spending is dried up. And that's what drives the economy. We're going into a recession, dude. So the inflation, that doesn't mean you can't have stagflation. That was last year. Now we're going to recession, no economic growth with inflation dropping. And as such, they're going to reduce interest rates. So if you locked in that 2 to 3 year CD at 4 or 5%, I think you're in a pretty good place. Yeah, right on, Theo. I got you, brother. So Texas, remember, Texas on the home equity line, it's not reverse mortgage. That's why I was not surprised that Texas mandates that both borrowers be 62. So Theo's got to wait for his younger half, the cradle from the cradle to get to 62 before he can do reverse mortgage. Because Texas mandates you can only have 70% loan to value on the home equity lines of credit. That means you have to have 30% equity because Texas is notorious for boom and bust in real estate. So anyway, I don't have any problem with that. I do know when I lived in Texas, that was a problem for me. When we were cash tight, dude, I was like, man, I can't even take a second line of credit. I can't even take it. It's Panama City Beach, right on, Brian. I guess people, DFW, I know what that is, but who would know PCB is Panama City Beach? That sounds, you live down there full time? I just don't know if I can handle Florida. I mean, dude, I like it. I like the villages. You got the Tampa. This people tell me Tampa is 45 minutes that way. The freaking whatever it's called, Cocoa Beach is an hour 15 minutes that way. It's like, man, that sounds fantastic. You got a bunch of freaking rabid gun owners in there. They're not going to be taken over by freaking gang bangers. All those old retirees with their rifles. These gangbangers come to villages, they're gonna have a whole army, standing army, ready right there to defend we're gonna defend this house. You know what I'm saying? Hurricane, could take you out, but probably not likely in the central Florida, not to the extent of the coastal area. So a lot to be liked about the villages, dude. You got a lot of right wingers, a lot of firearms, a lot of that's the thing, Harry. A lot of people. I guess the drawback for me is the fleeing of everybody north all at one time if things go south. And I'm not. You got to get out of Fulton County. You got to get out of Northern Virginia. You got to get out of Baltimore. You got to get out where the thugs run rampant, and Chicago's and all that. And if you want to call me racist for saying that, I don't care. I don't care if they're black, white, or freaking pink. Thugs run these counties, these blue counties. That's a fact, Jack. You don't want to be in Austin, Texas, for heaven's sake, like that guy who got convicted of murder. I mean, it's like, dude, do you hear the prosecution? By the way, they withheld evidence. So I'm reading Kevin Drum's thing on. He's a big lib. And I like Kevin Drum, actually. He's one of the libs I like. And all the libs like, I can't believe Greg Abbott's going to pardon this guy. The prosecution said this. And I was like, oh, so now the libs like the prosecution. I get it. So the libs love the prosecutors when we're prosecuting conservatives. I get it. I thought the libs were against the prosecution, though. Nah, dude, the freaking libs are full of crap, too, man. Just like conservatives, too. By the way, conservatives, they love the prosecution when they're going after low-level drug dealers, but man, you go after anybody else, they hate the prosecutor. It's like, no, the prosecution should always be held in contempt because they have the power to put you in jail. If the prosecutors are not, and I guess they don't have there's no legal responsibility for the prosecutors to freaking to share exculpatory evidence, whatever it's called, exculpatory. What the hell's that, dude? So you can put some guy in the jail and you knew that he had evidence to free him? It's nuts. Well, what I'm saying, dude, I think that's Prince Circuit. Where I go. Oh man, I grew up in Daytona Beach, right on. I still like the fall, dude. The fall just makes me happy inside. I still think it's Virginia for me, man. That place, Northern Neck, Virginia, something like that. Not the Outer Banks. What's it called? Where Cape Charles is. Got the water. You got the seasons. Oh man, and that still seems like the place for me. But I don't know. Northern Georgia is pretty nice. I think about this a lot. Like, where do I want to see? Like the Villages sounds awesome. Like Harry says, a lot of people. Man, the fall, dude. The foliage just makes you happy inside. Yeah. Anyway, what else is going on? What else is happening, amigos? I just don't know if I can handle the summers. But they're saying like they have music, they got ice cream shops, everything. I was like, man, that sounds nice, man. I'm not gonna lie to you. I just gotta have. I said, maybe you could plant a little freaking citrus tree in your backyard there. Oh man, oh yeah. I don't know. I will have to see where it shakes. The smell of the ocean. I miss it dearly. I'm not gonna lie to you. Being raised on an island, the smell. Like I was talking to people up in Long Island, New York, the other day. They're moving to Venice Beach, whatever that's called. Venice, something, Florida, is like 15 minutes away from the beach in Tampa. Looks awesome. And, this guy's, they raised on an island, Long Island. The seagulls, the smell of the water. Oh, dude, the sound of the buoys. I miss that some wicked, but I couldn't handle Maine. It's too cold, dude. You know what I'm saying? So, Delaware looks all right, but I'm not going to live in a blue state. Can't. Virginia's blue-ish. But you get out of the Metro DC area and Richmond, Virginia ain't blue, dude. It's kind of like PA. You get out of Philly and Pittsburgh, PA is right wing. It's kind of like even New Jersey. South Jersey is like Alabama, dude. It's awesome, man. 582 days till Joe quits his KOJ or COJ. And then you'll be moving to, wait, but aren't you going to move to Alabama? I thought you just already moved to Alabama. Hey, are you saying bye? I thought y'all moved in it. All right. And get out of here. I'm going to take these dogs for a poopy. God bless. Thank y'all for being here. And check out friggin' Don's class. I'll put the link in the show notes. All right. God bless, guys. I'm going to get out of here. Pablo, I got you. We'll see you.